Excellent. Thanks, Rob, and good morning, everyone. So a quick market snapshot, some of which Rob's hit the high points, but 21 was definitely a strong year for global REITs, 26% total returns versus equities at 22. And this was a little bit of a reversal of 2020, where the sector had faced some greater disruption from COVID, and therefore somewhat of a recovery year in 2021. Now, the Omicron issue is still causing some disruption and impacting the sector. So we are seeing some return dispersion, and that's playing out with different property sectors such as office and hotels seeing somewhat lower total returns versus those areas of the property market which have been more resilient or seen demand snap back, such as self-storage, industrial and residential, as you can see on those bottom charts there. We're also seeing regional dispersion where the US, UK has snapped back much more quickly, whereas Asia Pacific has been lagging. But broadly, if we look at real estate markets and particularly demand, we're seeing encouraging signs with tenant demand recurring as economies learn to live with the disruption of COVID. Now, we are also seeing significant increase in transaction activity and indeed REIT M&A. So the demand for physical real estate is very strong, and importantly, REITs are participating because their capital structures are in good shape and enabling them to be on offense, and that is different to prior corrections. And finally, as Rob touched on in his introduction, markets are grappling with rising inflation and high inflation in certain markets and what that means for bond yields, etc. And we'll touch on that as we go through. Now, quickly on performance, in the fourth quarter, we tend not to focus on the short term too much, but over the 5 years, compound returns of 9%, we would say is a fairly pleasing return profile for a high quality portfolio of listed real estate, which also offers investors the value of liquidity. If we look in the fourth quarter at how that return's been generated from portfolio positioning, and indeed this fourth quarter to a large extent reflects the portfolio returns through the year. So if we look at the sector first, so industrial property and residential property generated some of the strongest alpha for the portfolio in the fourth quarter, and this is reflected through the year as well. And that really reflects the strength of tenant demand that we're seeing in those two property types, which has really been exceptional in logistics property. Overnight, we just had Prologis, the largest position in the portfolio, report, and they continue to see extraordinary conditions in their portfolio. The e-commerce, the shift to e-commerce and the ongoing demand for logistics has had another layer of demand put on top with the supply chain disruptions we're seeing and the move from just-in-time to resiliency. So very strong conditions for industrial. When we look at diversified property, that was also a strong contributor, and really that's because the portfolio has limited, if any, exposure to diversified REITs. We have a strong preference for sector specialists who just invest in one property type, and those diversified vehicles did perform relatively poorly in the fourth quarter. If we look at detractors, cash was a detractor in a rising market, and also data centers and towers were a more modest exposure than the benchmark, and a couple of M&A transactions, one of which we didn't own, boosted performance for one of the data center companies. Regionally, Asia Pacific has lagged, particularly Japan and Singapore. The portfolio has a relatively modest exposure to those markets, whereas strong positioning in the US and Europe supported relative returns. Moving through to sector positioning and portfolio positioning, the core of what we're achieving here is positioning the portfolio in those areas of the real estate market where we see good secular demand trends. And that's demand which will continue beyond the ructions of the lingering COVID impacts, which we believe will provide multi-year demand trends supporting the real estate. And that's when you look at the big drivers of the economy, whether it's digitization, things like aging demographics and the need for healthcare, the affordability challenges around housing and residential property, the shift to e-commerce and logistics platforms. So when we look at the portfolio construction, there's around 70% of the portfolio which is positioned in these secular areas of the real estate market. So as you can see there on the pie chart on the left, residential, and this is all rental residential, is 23% of the portfolio, 19% in logistics, select retail at 15%, and then healthcare, data centers, self-storage, etc. The biggest overweight positions are residential, self-storage, industrial, and healthcare, where we continue to maintain a more cautious stance as things like traditional office, where the work from home, high vacancy rates in many markets around the world means that landlords haven't regained pricing power. And also diversified REITs, you can see a pretty significant underweight there. At the regional level, US continues to be and largely will be a significant part of the portfolio. It's the largest and deepest REIT market, and also has the breadth of property sector exposures. We also have big positions in the UK and Europe. Asia Pacific, you'll typically see the portfolio have more modest exposure in Japan and Singapore, given corporate governance concerns around the REIT structures, so more externally managed REITs there. Now let's talk through some of the dynamics which will drive the relative returns of real estate in this environment. So often when we're moving through periods of higher inflation, the concern around bond yields, REITs are often tagged as a bond proxy. What really drives the relative return for REITs is the ability to drive cash flow, and that rests on pricing power. So the core we're looking for is a good balance of tenant demand, moderate supply, and financed with appropriate capital structures. So broadly, tenant demand is improving as we learn to live better with COVID, and also you've got those big secular demand drivers that we touched on. If you look at the bottom left chart there, the property sectors where we're seeing the strongest rent growth, in line or above inflation, is residential property, self-storage, healthcare, industrial, with some of the other property sectors a little bit below that level after a very strong 21. We're seeing vacancy rates generally reduce, so that sets the sector up well for earnings growth in 2022. Moving to the supply side, in aggregate, the supply picture for real estate is fairly moderate. The experience of COVID has really delayed the delivery of new buildings through a mix of supply chain issues, labour, cost increases, and the disruption around being on site. So we're not seeing excess supply in most sectors, and the chart we're showing you here is new supply as a percentage of stock, with the exception of data centers, which we would agree is elevated. Broadly speaking, the new supply is not excessive. And what we're seeing in many markets is rising construction costs, rising labour costs, which all feed through to increased costs to deliver new supply. And that's all positive for existing landlords because it means it's more difficult to bring on new buildings, and the rents needed to justify new construction are also higher. And that supports the rents for existing landlords and supports the cash flow growth of the sector. So in aggregate, the supply outlook is reasonably supportive for the sector. Now, the finance structures are always critical to levered vehicles such as REITs, and generally speaking, they're in pretty good shape. The chart on the bottom left we're showing you there is debt to GAV, or the loan to value ratio, which is around 30%. And the takeaway there is it's significantly below where it was in the GFC. So the balance sheets are in good shape, and this is enabling the REITs to be on offense. So acquiring properties, growing the portfolios, growing cash flow, and also participating in some of the M&A we'll touch on shortly. And that's very different to coming out of prior corrections such as the GFC, where many were looking to repair balance sheets by selling assets, therefore lowering the earnings and cash flow of the vehicle. So the balance sheets are in good shape. The debt duration is extended, providing a more stable foundation for these portfolios. So just wrapping those 3 points up, demand is pretty good, recovering in many markets, definitely supported by those big areas of secular growth. We're seeing moderate supply, and the balance sheets and the finance structures are in good shape. Demand more broadly for commercial real estate has also been pretty significant. So two charts here we're showing to illustrate this point. On the right, this is global transaction volumes, so physical transactions of commercial real estate. And as you can see, close to record levels tracking in the third quarter there. On the left, again, historically high REIT M&A volumes. So significant demand for physical real estate and also for REIT M&A underpinning values. and there's significant pools of private capital or private equity money still to be deployed. And that's being boosted again for the demand for real assets in this sort of environment where the growing cash flows can provide a helpful hedge against inflation. Now, to give you an example, for one of the stocks in the portfolio, which has been a long time holding in the portfolio, is Alexandria. So Alexandria is a US listed REIT. They're a specialist owner and developer of life science, office and lab buildings. So this is a niche within office, which has been performing exceptionally well. Alexandria is the leader, having really been the founder of this sort of real estate, particularly in the listed market. And they provide lab and office space in key knowledge life science clusters in the US. So Seattle, Boston, New York, San Diego. And they provide the office and lab and workspace for tenants like Pfizer, Moderna, Merck, so pharma, drug development, and biotech companies. And those businesses have seen pretty strong conditions in recent years, and Alexandria's portfolio has benefited. So it's a high quality portfolio. Triple net leases mean there's typically less cash flow leakage in terms of maintenance, a very sound balance sheet, and that's been reflected in very strong annualized total returns. So this niche within office is performing exceptionally well and has been a good contributor to portfolio returns over a number of years. So moving to the outlook, it's clear that COVID is going to be with us for a while and the path remains uncertain. When we look at the current dynamics around inflation, it looks like we're moving to a period of market adjustment where markets need to grapple with what higher rates mean, and we've seen that with elevated volatility in the first few weeks of the year. When we look at asset prices more broadly, they're elevated, and we bring that back to the REIT sector. We see that also multiples are above average, and that does reflect elevated earnings growth as well. When we compare those multiples to broader equities, we're trading around average levels. When we look at the REIT fundamentals, the key factors which will drive the relative returns in this environment are the supply outlook, which is in pretty reasonable shape. It's tenant demand, so it's that recovery from some of the COVID disruption, and importantly, we've got over 70% of the portfolio in those areas where there's good secular demand, which will continue for years as we move through this disruptive period. Importantly, the capital structures are in good shape. So when we look at broader asset markets, yes, we acknowledge asset prices are high, but when we look at the REIT sector, we see limited idiosyncratic risk that gives us concern. So we continue to focus the portfolio on those areas of the real estate market that have pricing power, can grow cash flow, and that will drive the returns in this sort of environment and enable the portfolio to continue to fill its function in a well-diversified investment portfolio. And I'll stop there and open up for questions.
Thank you very much, Julian. As you illustrated on your final slide there's a lot of reasons to be positive about the sector. Now, do you think that will be represented within the market returns, or are you really focused on what is being generated by the underlying businesses?
Yeah, in the short term, it's difficult in public markets to provide you short-term target returns, particularly in what are very unusual markets and macro environments. And as we say, we focus on that 5-year horizon, and what will drive the returns while we move through some of this volatile period is ensuring that we've got real estate that can grow cash flow over time and is appropriately financed. And that's what will drive the return profile of the portfolio over time. Ignoring some of that short-term noise.
It'd be difficult to have another year of 26% or expect another year of 26%. But as you say, that there should be an element of inflation hedge within real estate because of the way that the economic growth and inflation feeds through to rental growth and how that comes through to the earnings of the businesses.
Yeah, that's a fair comment, Rob. So when we see these periods of above average GDP growth, when you've got corporate profits doing very well, you've got strong tenant demand, Importantly, you've got unemployment low in many markets, so you've got good demand for housing. The consumer has a reasonably healthy balance sheet. All this bodes well for tenant demand for real estate. So that will underpin the cash flows, which will support the inflation hedging prospects that you're highlighting there.
And so let's just touch on one sector, if you don't mind. So you hold self-storage in the portfolio. It's done very well for you. And on your chart about rental growth, it's been the second behind residential in terms of its ability to continue to grow rents. And you hold CubeSmart in the US, Big Yellow Group in the UK, and Sureguard in Europe. So do you see that continuing as perhaps maybe if we come out of the pandemic and start to go back to normal a bit, will people still need that self-storage?
Yeah, it's a good question, Rob, and I think it's fair to say that some of the demand for storage has been exceptional. You've got self-storage in most markets around the world at record levels in terms of occupancy, and there's definitely been an element of demand which has been driven by the pandemic. So that sort of societal friction generally boosts self-storage occupancy. So we would expect some normalisation of those occupancy levels over time. Some of it will prove sticky because it's introduced new people to the property type. And there are other drivers such as e-commerce fulfillment. So these can be considered sort of mini warehouses as well. But definitely there will be some normalisation of self-storage demand as more normal societal patterns ease. And then probably the next question mark is when does supply start to bite, and that's more of an issue in the US market, and whereas in the UK and Europe, those markets are significantly undersupplied compared to the US. So you may see us concentrate more of that exposure in the UK and Europe, where there is less supply, and less so in the US as those consumer demand trends normalise to an extent.
Thank you. And I think it's a fantastic example of the diversity of the subsectors within the global listed market that you're able to choose from. I'm going to have to wrap it up there, Julian. Thank you very much for joining us all the way from Sydney and staying late for us today. I really appreciate it. And thank you also for not mentioning Test cricket, because it's quite a painful subject at this point in time.
Thank you, Rob, and thanks everyone. Enjoy the rest of the day.